Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the book The Wealth Ladder, Achieving Financial Freedom at Every Level.
It's a fantastic topic for a deep dive, really, because it cuts through so much of the generic financial advice you hear everywhere.
Right, the stuff that gets repeated over and over again.
Exactly. And the core idea here is powerful because it's so simple. Financial advice is not universal. The whole thesis is that your strategy, your entire philosophy, has to change based on where you are on that ladder.
It's not just about different tactics, is it? It's a completely different way of thinking about money.
A different philosophy, yeah.
And the author drives this point home with an analogy about chess that I just love. He talks about how an amateur player, they spend all their time memorizing openings.
Right, the Sicilian defense, the Rui Lopez,
Yeah.
all the standard plays.
Exactly. And you're just hoping your opponent makes a mistake that you can capitalize on because you know the opening better.
And that works for a while until you play a master. And that's where he brings in this character, Victor.
Ah, Victor, the master player.
Right. And Victor doesn't have a fixed playbook. He sees a gambit from one player, and he accepts it. But he sees the exact same move from another player, and he just ignores it.
Because he's not playing the board, he's playing the opponent.
He's changing his entire strategy based on the context. And in our case, the context is your own net worth. The fundamental lesson is just effort isn't enough.
No, you can work 60, 70 hours a week, but if you're applying a level 1 strategy to what is now a level 3 problem, you are just spinning your wheels in the mud.
And we see this constantly. People think the solution to a strategic problem is just more hours, more grind, but the results don't come.
It's that Andy Grove quote from the book, right? The
Yeah.
former Intel CEO.
Oh, it's perfect. There are so many people working so hard and achieving so little. That disconnect, that gap between effort and achievement, that's almost always a strategy problem.
So this framework, it isn't about giving you a hot stock tip or a get-rich-quick scheme.
Not at all.
It's a philosophy to help you figure out which game you should actually be playing right now.
And which levers are the most powerful for you at your specific level. So maybe before we go any further, we should just define our terms, make sure we're all on the same page.
Good idea.
When we say wealth in this deep dive, we're talking about one thing and one thing only: net worth.
Your assets, so everything you own minus your liabilities, which is everything you owe. Simple.
And the framework breaks this down into 6 levels. And the key thing to remember is that it gets exponentially harder to climb the higher you go.
Okay, so let's walk through them. Level 1 is where the journey starts.
Right. A net worth of less than $10,000. This is where you're financially fragile, living, paycheck to paycheck.
Then you get to level 2, which is from $10,000 up to $100,000. This is the first real taste of a safety net for most people.
And then level 3, from $100,000 up to $1 million. And this level is so important. It's the big middle.
Right. The book says something like 43% of U.S. households fall right into this bracket. It's the biggest group by far.
They have some wealth, but they're a long way from being financially free. And then the jump. The jump to level 4, which is $1 million to $10 million, that's where the game completely changes.
Arguably the hardest jump to make.
It's a huge strategic leap. And then you're into the really thin air. Level 5 is 10 million to 100 million, and level 6 is anything over 100 million.
And the population numbers the book uses are, they're humbling. They really show you the scale of the challenge.
They do. Globally, you've got about 1.5 billion adults stuck in level 1. A massive, massive part of the world is dealing with that day-to-day fragility.
And at the very top.
It's a tiny village. There are only about 30,000 adults in the entire world in level 6. The drop-off is it's a cliff. The experience of someone at level 2 and someone at level 5 are just fundamentally different realities.
So what's the concept that ties this all together? Because there is one. And for me, this was maybe the single most important idea in the whole book. It's the BO 0.01% rule.
The 0.01% rule.
Yeah.
It's the universal metric. It dictates your behavior no matter how much money you have.
So what is it?
The rule is that the amount of money you can spend per day, and this is above your normal income, while still basically maintaining your wealth, is 0.01% of your total net worth.
Okay, so why that specific number? Why 0.01%?
It's based on a pretty conservative assumption about long-term growth. It assumes your investments will grow after inflation at about 3.7% per year.
So a real return of 3.7%.
Exactly. The source material is clear that this is a robust, safe number based on decades of data. So if you're only spending 0.01% of your principal daily, that spending is basically trivial. This is a tiny fraction of your conservative growth, so your nest egg isn't shrinking.
So that number, 0.01% of your net worth, that defines what a trivial spending decision is for you.
Precisely. Which means a decision that's completely insignificant for someone at level 4 could be absolutely disastrous for someone at level 1.
And you can map this idea of spending freedom right onto the ladder.
You can. For someone at level 1 with less than $10,000 in net worth, what's a trivial decision? It's between a cent and 99 cents.
That's it. So anything more than $1 requires real thought. You really are paycheck to paycheck.
But then you cross into level 2. You get past $10,000. And suddenly you have grocery freedom. Your trivial spending decision is now between $1 and $9.
And this is that great example about the eggs.
Yes. Should you buy the regular eggs for $3.99 or the cage-free organic eggs for $4.99? For a level 1 person, that extra dollar is a real choice.
But if your net worth is $10,000, what's $1? It's exactly 0.01% of your wealth.
It's mathematically trivial. You literally do not have to waste a single brain cell thinking about the eggs. Your long-term balance sheet is completely unaffected.
Move up to level 3, 100,000 to $1 million. You get restaurant freedom. Trivial spending is now $10 to $99.
You can get the steak instead of the burger without feeling guilty.
Level 4, $1 million to $10 million gets you travel freedom. Decisions that cost between $100 and $999 become trivial.
Upgrading the hotel room, booking the direct flight instead of the one with a layover, those are now your version of the cage-free eggs.
And then at the very top of consumption, level 5, 10 to 100 million gives you house freedom.
Right, spending $1,000 or even up to $9,999 on a home repair or an upgrade. It's just not a major financial event. It's a rounding error.
So the core message, the mandate that underpins this whole system is that you have to spend based on your wealth, not your income.
This is everything.
Yeah.
It is the single biggest takeaway from the entire framework.
It's the ultimate defense against lifestyle creep, right?
Yeah.
You could be a surgeon earning $500,000 a year, but if your net worth is only $20,000, you are firmly in level 2.
That's it. That income is a faucet, and faucets can be turned off. The data on this is really stark. High-income shocks, like a big bonus, tend to be temporary, but negative shocks, a layoff, an illness, those can last a very long time.
And if your whole lifestyle is built on that salary,
You're in serious trouble. That's how you see professional athletes or entertainers who make millions one year and are broke the next. They were spending based on their spectacular but temporary income.
while ignoring their net worth, which was probably close to zero.
Or negative. It all comes back to that quote from the book. The most expensive thing some people own is their ego.
Oof. Yeah.
That ego says, I make a lot of money, so I deserve the level 5 lifestyle. But the math of your net worth says you can only afford the level 3 lifestyle. The framework is the boundary that keeps that ego in check.
So it's not about being cheap, it's about being strategic. You're allowed to splurge, but only within the mathematical reality of your balance sheet.
Right, so your foundation stays solid.
Okay, let's move into the next part and talk about how your strategy for actually building wealth needs to change. Because just working for money has a very, very low ceiling.
It does. I mean, if you want to really climb the ladder, you have to go from being the person on the assembly line to being the person who owns the factory.
And the story of Konosuke Matsushita, the founder of Panasonic, is just a perfect example of this.
It really is. He started out in the electrical industry, and he was good. He rose up to become an inspector, which was basically the highest paid, most skilled job he could get.
So he had maxed out his human capital in that specific linear path.
Completely capped. He could only work so many hours in a day. His wage was fixed. If he stayed there, he might have made it to level 3, maybe. But level 4 was impossible.
So he left. He started his own company. And at first, he was still just working for money, right? He was doing everything himself.
Everything. Designing, building, selling. It was just a harder job. The real strategic shift, the leap, came when he started to scale.
When he created the autonomous divisions.
Exactly. He stopped trying to be the master craftsman of every single product and started delegating huge chunks of the business. That freed up his time and energy to focus on strategy, on growth, on deploying capital. He moved from working for money to having money and other people work for him.
That's the breakthrough. But let's step back down the ladder because most people are living in levels 1 and 2. The foundation gets built there.
It does. For level 1, under $10,000 in net worth, the book says your focus has to be on atypical actions and skill building.
And, crucially, doing it without taking on a bunch of high-interest debt.
Right. Because at this level, bad luck is just magnified like crazy. A car breaking down isn't an inconvenience, it's a potential financial catastrophe. The goal is just to reduce that fragility.
And the problem isn't really about cutting your spending, is it?
Not primarily. Most of your money's already going to necessities, rent, food, utilities. You can't budget your way out of it. The problem is income. You have to raise your income ceiling fast.
So that might mean taking the unpopular overnight shift, or getting a quick certification, or finding some weird side job, anything to create a buffer.
And this is where the book brings up the idea of social wealth. This is so critical at level 1.
When you have zero financial buffer, your network is your buffer.
Your network is your insurance policy. It's your family, your friends, your community. It's not just borrowing 20 bucks. It's someone letting you crash on their couch, or watching your kid for free, or helping you fix your car.
Without that social wealth, that network of support, financial wealth is almost impossible to build at this level.
It absorbs all the shocks that would just wipe you out otherwise. But once you have that buffer, once you get into level 2, 10 to 100,000, the strategy changes completely.
Now the focus shifts to education and working smarter. You actually have a little bit of capital to invest in yourself.
The mindset here is learn today, earn forever. You're using education as a form of leverage. You're investing in something that can't be taken away from you.
So this is your coding boot camp or trade school or night classes, something that directly increases your hourly wage.
You're trying to find that sweet spot, right? The intersection of what you're good at, what you're interested in, and what people will actually pay for.
Level 1 was about stabilizing your income. Level 2 is about scaling it through knowledge.
And that brings us to level 3, the big one. $100,000 to $1 million. This is the world of compounding and side hustles.
The game now is high-level optimization. Every big decision should be aiming to add, $1,000 to $10,000 to your net worth?
Right. And you're just relentlessly applying that. Just keep buying philosophy. You're feeding the machine. Because now, time is your most powerful weapon.
Which brings us to that fantastic Voyager program analogy.
Oh, it's so good. When NASA launched the Voyager probes, the scientists spent almost all their energy on the very beginning of the journey.
The launch,
Yeah,
the initial trajectory.
exactly. Getting that initial gravitational slingshot just right. Because once that was set, physics did the rest. It just amplified that initial input exponentially.
And compounding is the exact same thing.
It is. The book shows that in a 40-year investment window, the money you put in during the first 10 years accounts for more than half of your final portfolio value.
More than half. That's incredible. The earliest money does the most work.
Which leads to this really counterintuitive idea. Not just keep buying, but maybe go big, then stop.
Right. If you can be insanely disciplined for a few years early on and just front load your investments, the compounding curve becomes so powerful that you can actually afford to ease off later.
And while that compounding engine is running, level 3 is the perfect time for side hustles.
You're diversifying your income. You're not just relying on your day job anymore. You're creating new streams to feed that compounding machine.
And the examples in the book are just wild. They prove that these things don't have to be glamorous.
Like the Kent Island Express. This service that just drives nervous people across that terrifyingly long Chesapeake Bay Bridge.
For 25 bucks a pop. And it grew into a 6-figure business. He found a weird, specific fear and monetized it.
Or Twiggy the water skiing squirrel.
Twiggy, a side project that started from rescuing a squirrel during a hurricane in 1979. It became a whole traveling act that supported multiple generations of a family.
So whether it's driving over a scary bridge or teaching an animal to water ski, the lesson is the same. Find a niche, generate cash flow that's separate from your job, and use it to accelerate your wealth building.
And as you move through these levels from 1 to 3, there's a huge shift in what your assets actually are.
Yeah, talk about that. At the lower levels, your wealth is mostly tied up in stuff.
Consumption assets, your cash, your car, and overwhelmingly your house.
Yeah.
The book says for homeowners in levels 1 to 3, something like 65 to 75% of their entire net worth is the equity in their primary residence.
It's their biggest asset, but it's an asset that costs them money every month.
Right. But once you hit level 4 and beyond, that flips. The majority of your wealth shifts into income-producing assets, stocks, rental properties, private businesses.
That's the only way to get that exponential growth.
And that growth is powered by one thing, leverage. We have to talk about the 4 types of leverage.
Okay, let's break them down. This becomes mandatory from level 3 onward.
First up is the oldest one, labor leverage, using other people's time. The lawn care business example is perfect. You're mowing lawns, you hire an assistant, and suddenly your profit margin jumps because you can do 2 lawns in the time it used to take to do 1.
It scales really well in theory, but the book points out the big catch.
People are hard. Managing people is hard. HR, payroll, compliance, leadership. That overhead is a huge barrier for a lot of people.
Okay, what's number 2?
Capital leverage. Using other people's money. This is the world of asset management, venture capital, real estate syndication.
So instead of just getting a 10% return on your own 100 grand, you raise $1 million from other people.
And you take a fee on the profits. Your skill at generating a return is now leveraged across a much larger capital base. That's how you can make hundreds of thousands a year from your skill, not just your own money.
Third is content leverage.
Build once, sell twice, or sell 1 million times. This is the digital world. You make an online course, you write an ebook, you start a YouTube channel.
It's super scalable and permissionless. But the book says it's tough to get to the highest levels with content alone.
Usually, yeah.
Yeah.
A successful content creator often uses their free content as a funnel to sell super high-end coaching or consulting, which brings back in labor leverage.
And the final one is the big one today, code leverage.
The ultimate scaler. You build an app once and you can sell it 10 million times with basically zero marginal cost.
It's the golden ticket.
Yeah.
But it requires incredible technical skill, and you have to constantly maintain it, update it, defend it. You can't just build it and walk away.
And to really hit the stratosphere with code, you usually need equity. A piece of a huge successful company that's probably using all 4 forms of leverage. The lesson is just, to keep climbing, you have to master at least one of these.
Which brings us right into part 3, and maybe the toughest strategic challenge in the whole book. Breaking through the level 4 wall, the $1 to $10 million range.
Yeah, this is where the mental framework has to be completely rebuilt. It's that Marshall Goldsmith idea, what got you here won't get you there.
All the habits that made you a millionaire, the strict budgeting, the index fund investing, they won't make you a decamillionaire. Not in a reasonable amount of time anymore.
And the risk level just explodes. Level 4 is the first time that, for most people, the majority of their wealth is in volatile assets. A 10% market drop when you have $1 million is a $100,000 paper loss. Unpleasant, but manageable.
But a 10% drop when you have $5 million, that's a $500,000 gone. That feels catastrophic.
The book has that crazy story about the island nation of Nauru.
Oh, right. They got unbelievably rich from phosphate mining. Highest per capita income in the world.
And then they had to invest it. And they made just terrible decisions at scale. They blew a fortune funding a disastrous musical in London about Leonardo da Vinci.
Their tiny investment mistakes relative to their total wealth wiped out the entire country's fortune. It's a national-level example of the L4 risk.
And for an individual at this level, this is where the salary trap becomes crystal clear. Your portfolio starts making more money than you can.
Let's run the math on that because it's so important. Let's say you're a high flyer. You make $400 grand a year. After tax, living expenses, maybe you save $150,000. That's amazing.
It's incredible discipline. But once your investment portfolio hits $3 million, what does a conservative 5% real return give you?
$150,000.
Your money is now working exactly as hard as you are. And from that point on, your investments are out-earning your savings rate.
So trying to save your way from $3 million to $10 million is just, it's a brutal, slow grind.
The math is a killer. Even if you save $300,000 a year, which requires a massive salary, it still takes 17 years to go from 1 million to the bottom of level 5.
17 years of maximum effort just to cross the next line. It feels like a trap.
It is a trap, and that's why the book argues there's only one realistic way out of level 4. You have to shift your focus completely to equity.
You have to start a business, buy a business, or join a young business with significant equity. You need a piece of something that can have a massive liquidity event.
You have to stop playing the career game and start playing the enterprise game.
And this is where the book totally flips the script on the popular startup narrative.
Yeah, the whole you have to be a 20-year-old in a hoodie thing. The data says the exact opposite.
The average age of a founder of one of the fastest growing companies in the U.S. is 45.
45. No. Middle-aged founders are the ones who overwhelmingly have the huge exits. And it makes perfect sense when you think about it.
They have more capital.
More domain knowledge from working in the industry for 20 years.
And a much bigger, more valuable network. The research was clear. Having prior industry experience more than doubled the chance of a big, successful exit.
Experience beats youthful energy in this game. And it also comes back to that safety net. Having your own level 4 wealth allows you to take the big, calculated risks you need to take to get to level 5.
You can afford to fail once or twice without losing your house.
Which brings us to that final, critical distinction from Michael E. Gerber.
If your business depends on you, you don't own a business, you have a job.
And that is the ultimate pitfall for the person trying to break out of level 4. They start a consulting firm or a solo practice, and they just end up creating a much harder, more stressful job for themselves.
To get that L5 exit, the business has to be a system. It has to run on leverage, not just on your personal time.
The L4 wall is a mindset wall. You have to stop trying to be the best employee and start being architect.
So let's say you do it, you build the system, you sell it, and now you're in level 5, $10 to $100 million. The game changes again, doesn't it? The risks are totally different.
They're completely different. They shift from being strategic and financial to being personal and psychological. The operating principle for level 5 is what Andy Grove said: only the paranoid survive.
It's all about de-risking and protecting what you've built.
Right. And the path to get here is often that multi-exit strategy. The data shows that very few people make it this big on their first try.
They sell a business for, say, 10 or 20 million. They bank that, and then they go again.
They continue to play the game with higher stakes. That first exit gives them capital, sure, but more importantly, it gives them credibility and a network. But that first pot of money has to be protected.
And the biggest danger is the same thing that got you there: concentration.
Exactly. You got to level 5 because you were all in on your one successful business. But to stay there, you have to diversify.
And the book gives that incredible cautionary tale of Ike Batista in Brazil.
Once the richest man in Brazil, his entire fortune was tied up in his own companies. And when his main oil company collapsed, everything went to zero. Almost overnight, he just tumbled right back down the ladder.
So beyond investment risk, there's a new focus on personal liability, right?
Huge focus. Level 5 gets you house freedom, but it also makes you a massive target. You need millions in umbrella insurance. You need lawyers on retainer.
Things that were minor issues before are now potentially multi-million-dollar lawsuits. A guest slips and falls at your house, your dog bites someone.
It's a completely different level of risk. And that paranoia seeps into your personal life. It leads to this really insidious problem: the loss of trust.
Wealth can be so isolating.
Incredibly. You're constantly second-guessing everyone's motives. Do they like me or do they like my money? Every new relationship is filtered through that lens.
It's the Huguette Clark story. The heiress who was worth hundreds of millions but spent the last 20 years of her life as a total recluse in a hospital room.
Her financial wealth kept compounding, but her social wealth, her relationships, they just dwindled to nothing.
And then we get to the absolute peak, level 6, 100 million and up. The problems here are almost not about money at all anymore.
They're almost entirely philosophical. You've reached consumption saturation. There's nothing you can buy with $1 billion that you couldn't basically buy with 100 million.
So the focus has to shift. It shifts to impact, freedom, and legacy. And the formula becomes legacy equals your action multiplied by your wealth.
The Alfred Nobel story is the quintessential example of this. He made his fortune from inventing dynamite, weapons.
And he read his own obituary by mistake. The newspaper published it early.
And it called him the man who became rich by finding ways to kill more people than ever before. And he was horrified. So he spent the rest of his life and his entire fortune creating the Nobel Prize to completely rewrite his legacy.
It's an amazing story. But even at this level, with the power to change the world, there's this psychological trap: relative deprivation.
It's so powerful. The higher you climb, the wealthier your peer group becomes. Your reference point for normal just gets completely distorted.
When you're worth 100 million, you're not comparing yourself to your neighbor anymore. You're comparing yourself to the person with 500 million or 5 billion.
And your objectively massive success suddenly feels inadequate.
Even Charlie Munger, one of the most brilliant and successful people of the last century, he fell into this trap.
Right before he died, someone asked if he had regrets. And he joked he wished he'd had multiple trillions instead of multiple billions.
It's that never-ending then syndrome. It's never enough.
And this chase has a real measurable cost. The book talks about the inverted U-shaped relationship between wealth and mental health.
It improves your well-being up to a certain point. It gets rid of the stress of scarcity.
But beyond that point, often in L4, L5, the stress of managing it all, the paranoia, the constant striving, it actually starts to decrease your well-being.
And it messes with your family dynamics. The research on affluent kids is pretty clear. Higher rates of anxiety, substance abuse.
And it's not just because they're spoiled. It's the pressure to achieve, and often emotional distance from parents who are totally consumed by their careers and managing their wealth.
It's that Warren Buffett idea. You want to leave your children enough money so they can do anything.
But not so much that they can do nothing. It's an incredibly fine line to walk. The problems become entirely non-financial.
So when you boil it all down, this whole framework, the wealth ladder, isn't a rigid set of rules. It's more of a roadmap for your mindset.
Exactly. It's a philosophy that evolves as you evolve. The core idea is seeing how the importance of different life factors changes as you climb.
Right. In level 1, money just amplifies luck, good or bad. In level 2, it amplifies your career choices.
Levels 3 and 4, it's all about amplifying your investment decisions.
But up at levels 5 and 6, the biggest amplifier is on your personal relationships. Family, friends, trust, all of it.
As you get wealthier, the marginal utility of the next dollar just plummets. The problems you face in level 1 are tangible. Rent, food, money solves those.
The problems in level 6. Isolation, lack of purpose, stress. Money can't solve those. In fact, it might even make them worse.
Which is why those other forms of wealth are so critical. Social, mental, physical, time. Your financial wealth is just a multiplier for those things. But it can't create them from nothing.
Financial wealth multiplied by 0 is still 0.
Exactly.
And that's the final lesson, isn't it? That logarithmic link between money and happiness. Going from level 1 to level 2 is a huge jump in life satisfaction because you're eliminating real, immediate pain.
It's a massive leap. But then to get the same boost in happiness later on, you need exponentially more money. And you get caught in that never-ending then trap, always chasing the next level.
So the real challenge the book leaves us with is that the goal isn't just to climb as high as you can, it's to find the summit that's right for you.
The one that's defined by a balance of all 5 types of wealth, not just the financial part, but we all face that paradox that Daniel Levinson talked about.
We're required to make crucial choices before we have the knowledge, judgment, and self-understanding to choose wisely.
We have to choose our path long before we know where it really leads.
So since money matters a great deal until suddenly it doesn't matter nearly as much, we have to leave you with a final thought to chew on.
What non-financial asset, your time, your health, your relationships, are you intentionally and actively investing in right now to make sure that your own journey up the wealth ladder is actually worth the climb when you get there?